Hello, everyone. This is Sasha from Hesia Holdings. I'm a managing partner. Excited to be with Wayne Woods and Zach Schoefel, two excellent general partners that we invested in, to talk about the outlook for 2023, especially in multifamily. Wayne and Zach, nice to see you guys. Happy holidays.
You too. Thanks, Sasha. Happy holidays.
Uh,
Happy holiday.
Zach, do you want to start off to introduce yourself and your firm?
Yeah, sure. Thanks, Sasha. I'm Zach Schoefel from Eastman Companies and Eastman Residential. We are a third generation family office based out of New Jersey. We owner, operator, developer. We've developed more than 5 million square feet of office, retail, industrial, and multifamily. Over the past year, we've expanded out of the New York City metro tri-state area into the Southeast, where we acquired just under 1,000 units, north of $110 million in total capitalization, and an office building. I'm specifically focused on the multifamily group. However, acquiring and developing multifamily. However, we're actively working on other retail acquisitions, office acquisitions, and self-storage development throughout the tri-state area.
Great. Thank you, Zach. Wayne?
My name is Wayne Woods. I live in the Boston area, and I primarily am invested in the Dallas metro market. We've acquired about 600 units over the last year and a half or so, primarily C-class. I have a research engineering background, but have been a real estate investor for about 17 years. And yep.
Great. Thank you, guys. Zach, we closed our first deal early in 2021. The market has significantly changed since then. Would love for you to tell us, how are you navigating this market? What are you seeing? And what are the biggest differences you're seeing this year compared to last year?
Yeah, sure. So I guess first and foremost, fundamentals last year versus this year. Not much has changed aside from debt, and obviously debt is a residual on just the going in cap and exit cap where properties are trading. But outside of debt, which is a very important metric of how we're analyzing real estate, the fundamentals on multifamily are still very strong. We're very bullish. Few reasons why. The extreme housing shortage across the United States. The supply needed to meet demand is about 4 million units, and the supply chain can't meet that. We're not going to meet that 4 million shortage this year, next year, or likely within the next 20 years. So there is a shortage of housing for the foreseeable future. Outside of that, compared to historical lows, compared to the historicals, employment is still low. And home ownership costs are high. People can't afford to buy homes with the rising cost of debt. And both last year before rates ran, and even more so this year as rates ran. So this is leading to more demand for multifamily. And specifically just some short-term fundamentals regarding inflation. Inflation has caused the Fed to just increase rates, but rent growth over the past few years has been really high, and people don't foresee rent growth continuing. But when people talk about just specific to the Southeast and in Nashville specifically, rent growth the past 2 years has been about 10%. Most groups in our group, we're underwriting 2 to 3% of rent growth. They're assuming that rent growth isn't going to continue at that 8 to 10% that it has the past few years, but it's still projected to be above the historical averages of 2 to 3%. And as it relates to just wage growth and rent growth, the lowest end, the bottom 25%. Of wage growth over the past year is 7%. So, which is another reason we're really bullish on workforce housing, because workforce wage growth at 7%, where assuming rent growth at 2 to 3%. So people are having more money to spend on rent. Obviously, inflation is up, but specific to rent across the board.
Thanks, Zach.
Yeah.
Wayne, you've been in the trenches for a long time, like me. We talk a lot about the markets and how to look at multifamily. I do believe that the multifamily right now is a great way to navigate this market. Would love to hear your opinion and what you're seeing and what you're doing and the differences between last year and this year, and how you're looking into next year.
Yeah, I would agree with a lot of what Zach said, that the fundamentals, especially in the metro markets that I think that he's in Nashville and also where I'm in Dallas. I mean, if you look at the in-migration, you look at all the fundamentals are unchanged. In this market, essentially, it's the debt markets that have changed. It is a huge driver. However, if you take a step back and look at it, I kind of think, history doesn't repeat, but it rhymes. And if you look at the 70s and you look from the mid 70s to the mid 80s and you look at the best performing asset classes, they were energy and commercial real estate. And if we are truly heading into kind of an inflationary environment, it is going to be inflationary in many things, wages, prices of expenses, of course, but also for rents too. And I think that you're going to have, in a recessionary, we may be heading into a recession coming in 2023. That's going to have downward pressure on some rents short term, but long term, over the next 4 or 5 years, combined with the fundamentals, I think that you have positive, inflationary pressures. And then in terms of like looking for deals right now, there's so many people who are pencils down. And if you're looking for deals, it's a good time to look right now because there's opportunities. You don't have 20 people in front of you. You can actually take a look and pass on a deal, but you have an opportunity to pick it up if it makes sense. And the cap rates are kind of expanding right now. You can find things with true positive leverage for workforce housing, and even with today's rates on a agency loans. And you could also find stuff, I think, positive leverage in terms of what's the interest rate relative to the anticipated inflationary growth going forward. This is what Sam Zell did in the 70s. He would take things with loan assumptions at 4 or 5% in an inflationary environment at 8%. And the way that he thought about it was he had basically positive 3%, whatever the difference is between the true inflation and the rate he was getting on the debt he was assuming. So I don't think I think it's a good time to keep steady and look for opportunities as they come available. I think the fundamentals are behind us, and fixed rate debt would be nice to have. Fixed rate debt that you can exit in a reasonable manner, and something to where you're ready to hold for a long term.
When we were fortunate, we closed our deal a couple months ago, where while we were preferred equity there, because right now we would rather be in preferred equity until we understand where the volatility is going. You were fortunate though, because we closed the deal where the debt was 4.58%, I believe.
Yeah.
And that was long-term debt. That same debt now I'm seeing are between 7% to 8%. How should one think about underwriting when debt is so expensive now? Like what are the key
Well,
things?
I'm actually seeing, believe it or not, for some agency products like Fannie and Freddie, I'm seeing rates into the mid fives and high fives. Certainly for other types of debt, they're at the interest rates you're talking about. I wouldn't mess around with those right now. I'm trying to focus almost exclusively on agency or maybe non-recourse bank that would give me similar quotes to an agency loan. I just want something that's relatively fixed, that's got a decent exit, even if I have to pay a little bit for that exit, or an assumption. If you could find an assumption, even if there's no IO left, if you could find a 4 or 5% assumption, even with the IO burned off, it may be a lot better. You might be able to, those kind of things are what I'm looking for. But yeah. I think variable rate for years, the assumption was the smart money was that variable rate is invariably better theoretically than fixed rate debt under almost all scenarios. But the last 6 months we went through was, I think, one of those outlier scenarios that they talk about where short term, the debts rose so quickly, the SOFR rate rose so quickly that, that's it, and it's going to cause a lot of buying opportunity because there's a lot of people who are now underwater with their mortgage payments. They did not get the right rate caps. They're going to be motivated to sell and unload assets that are negative cash flowing. And it could be a good time to pick them up.
Got it. How about you, Zach? How are you navigating right now the debt market? I know you and I are talking about some deals that you're looking into. When you're underwriting, how are you? What changes have you made now that debt is a lot higher?
Yeah, sure. So I would say first and foremost, proceeds are being impacted just across the board with rates where they are today versus where they were a year and a half ago. Deals that we were being priced 70 to 75% are now being priced 50 to 60%. So there's a few options. The deal doesn't make sense, you don't do the deal. Or in order to get to that same leverage point, you have to take on some pref equity, which unless the deal has a significant amount of value add to it, it usually is harder to swallow to take on pref, because the pref becomes in the superior position to the capital stack. So something that we've really been focusing on, and Wayne and Sasha, Sasha, you mentioned kind of debt today being at 8 to 9%, and Wayne, you said this really well. And all other things being equal, we would prefer to take on fixed rate debt with an easy prepayment, with there being a lot of uncertainty in the market. To have the flexibility of the fixed rate and the prepayment would be the ideal debt situation today. However, there will be a lot of opportunity over the next few years, and we're already seeing a lot of it today with distressed assets. And assets could be distressed for a few different reasons. It could be just a bad management company that frankly either just didn't do a good job managing it, took on a lot of bad apple renters, and bad debt was higher than it should be, and current occupancy, they have a lot of evictions which they're having trouble getting out, and a lot of bad debt, bad occupancy, and they won't size for fixed rate debt. Sasha, we recently closed a student housing conversion deal together. And we're looking at another student housing opportunity right now, which they missed the student housing turn, and it's ripe for conversion to conventional, just where it is, and current occupancy is at 70%. So in order to take down these assets, you will likely need to do some sort of variable floating rate debt. And that debt, we look at that debt as short-term debt. How quick could we stabilize the asset and refi out into fixed rate debt? But it's important, especially with a lot of the distress over the next few years, that negative leverage and variable debt, it still could be the right type of debt for the right type of opportunity. Certain opportunities don't allow for that fixed rate debt, and you're able to acquire these distressed assets at a steep discount to stabilize value and to market. And by taking on that type of debt, as long as you're and certain assumptions to watch out for is just the renovated rents, and also just like the mark to market, because once you stabilize an asset, those play an important role in that refi. So just a lot of the opportunities we're looking at right now, Sasha, are distressed, which would require variable rate debt. So it's just important that there's all good types of deals, and some may not just be fixed. Some may include variable rate debt as well.
Right. I mean, I think, Zach, we should also clarify a little bit, like what I guess with distress, you mean occupancy is a lot lower, which makes it distressed. But I think also we were equity partners with you because I think that in the past, I've been saying it since 2011, the market was going to go down, market was going to go down, things were going to change. And we went 10 years before we saw rates mean anything. I think that, especially the past 3-4 years, there was so much money coming into the market, so many syndicators, everyone wanted to do multifamily, and just started pouring so much money into Class C apartments that it got really hard to add value. And I think that, Zach, what did differentiate yourself was, you were doing student housing and converting that to multifamily, right? And so there was something that you were doing different. And at that moment of time, we were comfortable doing equity with you, because it made sense. Like if the market went down, at least we knew that there was enough of a cushion because you were adding significant value, because we were just nervous about what we were seeing in the market. With you, Wayne, and you've been doing really well. We did preferred equity because we were nervous about where the market was going now that rates were going up, and we were playing the preferred equity because there's a cushion there. We felt that if you hit your benchmarks, you can keep all the upside. Going in 2023, where we think we want to, there's a window for that, but there's windows for real value added. And when I mean value add, doing things that are different rather than just buying multifamily, fixing up it and selling it. Wayne, what are you seeing in 2023? Are there strategies that you're looking for that you think will differentiate yourself?
I mean, I think that the things that I'm looking for right now, I'm seeing expenses go up and a lot of these like workforce housing things. And, we're definitely more in the vanilla category of we haven't done heretofore really heavy, like distressed, although to Zach's point, a lot of the most positive returns that I've seen, from partner deals and things have been the heavier turns. I mean, effectively, they have a very large value add component. But I mean, like the expenses that I've seen for like plumbing problems of 60s buildings and things like that, everything's gone up. The insurance costs have gone up, the payroll costs have gone up. Certainly, we're underwriting a lot higher expenses. I think that primarily going forward, what we're going to try to do is to get a little bit better in class to try to avoid some of these typical C class issues. And we're still going to be long-term holder type strategies instead of a shorter term hold, more like 5 years. But we're going to try to start getting PVC pipes in the ground after 1983 type construction. And then looking for things where the debt is advantageous. We could also be making offers for, sellers who are willing to carry back. A lot of people can't sell, and there could be some opportunities for creative financing. We've done it in the past, where basically you put them as kind of a different class within your structure, and allow to bridge to get a little bit better loan to value. And I think that just keep looking for the opportunities and keep trying to make offers when others are out of the market. We've certainly seen that, where the multiple rounds and the best and finals, they're not there now. It's really a buffet shopping. You can get it if you want it. That's good. So we're going to try to take advantage of that and take advantage of the things that we know long term are going to look good in 5 or 10 years, and get debt that we could hold it for 10 years if we have to. And that's going to be a differentiating strategy in the sense that on the properties we did, including the one that we did, we have 10-year fixed rate debt with 5 years of IO. We can make it to another market cycle if we have to. These are positive cash flowing properties, and we're in no pressure, so.
I mean, can you talk a little more about also your focus on Texas, and we love that area to invest in. Talk about, again, what are some of the things you like about Texas? The deal that we did together was in Irving. Talk about that and your outlook in that, because I think that going into 2023, not only do I think that multifamily is the safe place, one of the safer places to be as we navigate these volatile times, but you also have to think of regions. And I think Texas is one of the safer places to be. So talk about Texas to why you chose Texas as opposed to some other places.
Sure. I mean, I'm originally from Louisiana, even though I live in Boston. I've been flying out of Dallas for years. And when I kind of graduated from like doing duplexes and things like that years ago, I started looking at multifamily in Dallas and making offers, and got in with some partners in Dallas who have some boots on the ground there. And then it just made sense. And what I've seen from investing passively before that was I like Texas in general, and I'm down there all the time, so it made sense to invest there. Uh, but when I looked at secondary markets, this is kind of the whole thing of cap rate compression between the Class A and the Class C. Uh, there was also cap rate compression over the last few years, and I know Neil Bawa and some of those people have talked about this, but we've certainly seen it between secondary and tertiary markets and primary markets. Now, for me, Dallas is a primary market. I know that for people, some people, they wouldn't consider that. Maybe New York and Los Angeles are primary and Dallas is secondary. For me, Dallas is a primary market for me. And what I've seen is that the cap rates are not that dissimilar from, say, a Dallas or a secondary market. And so if I'm not having to pay a huge cap rate premium to be in a major metro market with a lot more buyers, I'd prefer to be there. And that has held us in good stead so far. And all of the other investments I've made there, it seems to have done well. I mean, not to say secondary, tertiary markets can't do wonderful too, but all the demographics are also the in-migration, both from California and the Northeast, and also coming from south of the border. There's over 130, 150,000 plus coming in a year into the DFW area. And if you look at the DFW metro area, it's 8 million people and it's growing at 2 to 3% a year, which doesn't sound that much. But in 20 years, it's going to be bigger. The growth in 20 years, just the addition, is more than the entire Boston metro area where I live combined. All the suburbs, 4 million people. They're going to grow that much just in the next 20 years. That's a huge amount of growth. And for the markets we've been looking at heretofore, like workforce housing, they're not building anything new. All the new stuff does not compete with us. So I still think it's, you have the mechanical challenges of older pipes and things like that, but I think it's still a solid investment strategy going forward.
Right. And one of the good things about Texas also, though, is it's, like you said, not and is it is growing, but the economy is diverse enough, right? You have oil and gas, you have medical, you have real estate, you have healthcare, you've got universities, you've got everything there needed to anchor a thriving economy.
Right. If you look at Irving, where we're invested, they've got some huge number of U.S. headquarters of like Fortune 1000 companies, including Caterpillar just moved from Minnesota or wherever they are into Irving. And so are a lot of other ones that are coming there. I mean, it's kind of centrally located in the U.S. You have a low tax environment, business friendly environment. It's very, the business outlook for Dallas is good for decades to come.
Right. How about Zach? Talk a little bit more about Tennessee. You've been focused on Nashville. Any dynamics you want to point out there? Because I do think that, again, having worked with you, that Nashville has all the similar characteristics as Texas.
Yeah, I think a lot of the drivers for why Dallas and the Dallas MSA and Irving Wayne is really bullish on kind of is similar to Nashville. Basically, just Nashville on a kind of past 10-year horizon, 3x the U.S. net migration on the past 10 years and top 10 metro growth 5 out of the 6 years. Nashville has 20,000 jobs that have been announced by major corporations, Amazon, Oracle, and some ancillary organizations that are coming to Nashville with those organizations that will not deliver until 2025 and 2026. And I feel like it's as there's every other week, there's another major announcement to Nashville. So outside of Amazon and Oracle, there's 2.8 million square feet of office under construction outside of downtown. So this is, if you're familiar with Nashville, Nashville is sort of like Atlanta, how you have downtown Atlanta, but there's a bunch of business districts within Atlanta. And one of the reasons we like Atlanta, it's a very diversified MSA. You don't have one downtown. I believe Dallas is very similar. How there's several mini CBDs within Dallas, the MSA Dallas. Nashville is very similar. You have Murfreesboro, you have downtown Nashville, you have Hendersonville, Gallatin, and you have Franklin and Cool Springs. All each of which have more than 2.5 million square feet of office, and office vacancy sub 15%. Also, just kind of highlighting the growth in Nashville and the supply of housing. The future jobs with the supply ratio of Nashville is 2 times more than previous years, and the lease up at our properties, just for example, in the past 5 years, 150,000 jobs have been delivered in Nashville between 2014 and 2020, and 50,000 jobs were built during the same time frame. That equates to 3.2 jobs per unit. Over the next 5 years is projected to be 6.5 jobs per unit based on the planned construction today. And frankly, with the rise of interest rates, a lot of these construction projects are either delayed or just pausing, as a lot of these projects in Nashville are covered land plays to an extent, and they could continue to operate as instead of and sit on the land. So we're really bullish about those fundamentals, specifically to the entire Nashville MSA, where there's a huge shortage of housing, specifically workforce housing, throughout Nashville.
Got it. So how are you, if there is a recession next year, do you guys still think multifamily is an asset class to be in? And when you're looking for an asset, what is it when you're like, okay, aha, this makes sense, you want to do that? You want to tackle that first, Wayne?
Yeah, I mean, I think at least in the units that we have right now, we have very low vacancy, and we're seeing rent growth still strong. And I think for a recession, and there is income growth in the tenant base that we have. There's been pretty strong income growth in a lot of it, and it's reflected a lot in the labor costs that we see for the apartments ourselves. The hourly wages for people have gone up dramatically, and over the last couple of years. Now, it may be leveling off some, but it's certainly a lot higher than it was 2 years ago. And the rents have not quite caught up yet, even to that level of income growth. And I think that given the population that's coming in, even if the recession affects the job market somewhat, there will still be a very large amount of people who need a place to stay and can pay the rent. And we're not pushing rents dramatically. None of the things that we have underwritten, we don't need 15-20% rent growth, for example. We're pushing them fairly modestly. And we're basically just pushing them to the levels that we're already getting in the existing market. So for us, I think that I'm not really worried about a short-term recession or a recession for the, we're positioned to hold for a while, and I just don't see it affecting us. I'm not looking to sell anytime in the next couple of years. So, but I mean, I think it would be very good for purchase. I think I think that negative news right now is good news for buyers. If you keep your mind in the right way and you could look for opportunities, it's a good time to be looking.
Interesting. Hey, Zach, interesting enough, Zach, if you remember last year around this time, you and I were talking about crypto, and you made an interesting comment. I remember, I'll never forget it. You said, I dabble in crypto, but real estate is where I love to be and where I want to be. A year later, it looks like you were in the right place to be to real estate. So how are you thinking about investing in real estate in case we're in a recession?
Yes, Sasha, first off, that comment is very funny. I actually studied in college blockchain at Syracuse University. It was one of the first universities in the country that had a blockchain program. So I'm still bullish on blockchain technology as a whole, but obviously crypto, the way it's moved over the past year, I think it's getting at a lot of the bad actors. And I just to kind of clarify, I believe in the blockchain technology as it kind of relates to our day-to-day processes today. But I am happy I am in real estate. but
So how,
I do watch from the sidelines.
so how
So
do you think about Zach though? If we are in a recession, how do you think about investing in real estate?
yeah, yeah, sure. So I think we're kind of highlighted at the beginning where very enamored and bullish, and we continue to be bullish on the fundamentals of real estate long term. And as for our current assets, we've acquired them low leverage at really strong bases, and we we use very conservative rent assumptions and expense assumptions, and it's what we continue to do as we underwrite deals on a daily basis. Just we like to underpromise and over deliver. It's just our company, one of our company ethos. It's for our properties that we're looking at, and just our existing portfolio, multifamily, office, retail, industrial. We're all in a really good position in terms of just positive cash flow. Properties that are executing a repositioning, such as the Johnson portfolio that we recently acquired, are achieving very strong rent trade outs, well higher than our projections. We're at our year 3 rents at the end of year 1. And just from a budget perspective, where our performer for year 2, we anticipate will be between 400,000 and 500,000 above that. And that's net operating income, primarily driven by the increase of revenues. Just the short-term rise in debts is hampering cash flow, but it will still be in line with the projections due to the success we've had top line on revenues. As we're looking at new opportunities in real estate, we hope that the market stabilizes and the Fed does not continue to lower rates. And we would love to see some pain in the market. We would love to have the opportunity to buy and acquire deals at a good basis with less competition than we've seen the past few years. And frankly, we think where debt is today it is our internal opinion that this is where debt will be for the next few years, and this is the new normal. So we're underwriting based on that prediction, which is a bit more conservative than kind of where the Fed is predicting. With that being said, we think there'll be a lot of opportunity to acquire distressed assets and also just stabilized assets where people have bought over the past 4 to 5 years and they're scared about the uncertainty in the market, and they can exit for a small gain, but a gain nonetheless, because their debt is expiring and either themselves or their equity partners just frankly don't want to put more cash in or just want to exit. So we think there will be a lot of opportunity there. As it relates to our underwriting, just Wayne mentioned this, but just to put it into perspective, where payroll has moved over the past few years, we've seen a significant rise in payroll, specifically to maintenance workers. There is a shortage of about 2.5 million people in the United States for skilled labor. And about 2 years ago, the market in Nashville for a maintenance tech was between $17 and $18, and today it's between $22 and $23, and that's a rise of about 30%.
That's almost exactly what we've seen in Dallas. A little bit higher. We went from 18 to about 25 plus.
Yeah, and it's not only material for operations, it's material for value add programs too. And it's important as we evaluate new deals that we consider and take this into account for the cost to renovate a unit. So for on average, to do a standard value add program will cost about 12.5 to 13,000 a unit, and labor was most recently at 3,000, and we redid our budget for next year with our vendors, and we're seeing about a 20% increase. Labor is costing about 4,000 now, and that adding $1,000 per unit when you're dealing with 400 or 500 units, that's pretty material to the budget, and that's not accounting for other non-interior items that have increased and that have increased over the past few years. So it's just important to be cognizant of this as you look at new opportunities over the next year and over the next few years. But while taking all this into account, we believe there'll be a ton of opportunity in 2023, and we're already seeing this now, and we're actively looking at.
So Zach, are you saying though it would be with these cost increases that with the market can shake off, you would almost prefer a recession almost because that would hopefully put pressure down on labor and things of that nature? Is that what you're thinking?
Yeah, no, I was just saying, just from if there's a recession, it will basically, this is saying that people are left naked when the water and the tide comes down, and we feel like if debt stays where it is over the next few years, there'll be a lot of people left naked, and an opportunity to acquire real estate and good real estate and good locations, good school districts at really good bases. So we're not hoping for a recession, but if there is a recession, our portfolio and a short-term recession, our portfolio is in a very good position, and this will allow for more opportunity for the foreseeable future.
I mean, that's going to be interesting. I mean, if you're seeing costs go that far up right now, debt's going that far up right now, you're really going to need really a very attractive basis eventually. Prices are going to have to go down significantly from where they are, and cap rates are definitely going to have to widen out way more than where they are right now. So that's going to be a very interesting development. You want to add to that, Wayne?
Yeah, I mean, I've seen recently a couple of different broker reports that kind of speak to that, where, kind of like in the Michael Becker article I'd sent you, his idea was that, you've got this compression between the C and the A. The thing is, I think that's gone now. It's already gone. Just in a couple of months, that it's expanded out. Like traditional value add C class is now in the high fives in terms of cap rate, real cap rates. And the C class is kind of in the A class is in that high fours. And I've seen some people have a different take on which markets are going to go, like the A class, it actually may be negatively impacted by negative absorption of new construction. And there's a lot of new construction out there. So I don't think, but we're not really playing in that space right now. And ironically, it could be that it's worse for multifamily if there's not a recession, because the Fed may back off if there's a recession, and there could be an interest rate relief. A lot of people, I think, are betting that the Fed is going to blink and there's going to be a pivot in mid-2023, and that will give some relief to the interest rates. I tend to agree with Zach. I think that where we're at is where it's going to be through 2023 and a little bit higher even. I think that this is kind of the new normal. We are coming out of a blip of very unusually historically low interest rates, and they have to adjust at some point to some kind of a normal interest rate. And I think that is going to push a lot of people who are hoping that the rates come down to sell. That's going to motivate a lot more, either way, they're going to be motivated to sell. But I think in a way, a recession could actually provide relief for the multifamily market in terms of interest rate.
I mean, Zach, I hate to say it. I don't know, based on what you told me, I don't think I'd do equity right now. I think I'd stick to my preferred equity thesis, because from what you're saying, that could be scary. If prices are going to continue to go down, being in that layer where you're not going on the upside and you're just playing in a middle range mezzanine or preferred equity as you wait to see what the market does, it feels to me that that's where I would want to play. I'm sure you guys would prefer the equity, but from hearing what you're saying, it just seems like preferred equity right now is where to play it safe until we figure out where the market's going. I would like to hear if you guys want to comment on that. Just
yeah, no, I mean,
that's wearing my hat right now.
Sure, I mean that's not a bad thesis, and we've looked at some pref opportunities ourselves, but keep in mind a lot of owners, if there's a really good deal, there's going to be a demand for equity. And as pref equity, you might not have the access to I would say some of the most attractive deals. And obviously it's a lot of people love to do programmatic ventures, and especially when on a deal by deal basis, and there's just mutual interest on both sides. The LP equity thinks it's a really interesting deal and they want to invest in it, and the GP has a really interesting deal. But a lot of these deals will have LP equity interest, and frankly will not need pref equity. Pref equity, some sponsors like pref equity because it could juice the return, especially if they can exit quick or refi quick. But some operators, I would say like ourselves, and that are longer term holders, frankly, like there might not be an opportunity to do pref. But granted, Sasha, what you're saying, being in the pref stack, it limits your upside, but it also significantly limits your downside. And I think it is an interesting and frankly, probably a really good investment thesis right now, especially acquiring these assets at a lower basis today than they were a year and a half ago, a year ago. And with the same strong fundamentals, it pencils well as equity, but you're okay not getting all that upside by capping your downside and being in the prep position. I think it's a great investment thesis, but I also think you don't have that upside, and especially on which is okay, especially in a diversified portfolio. It's important to kind of to limit that and have a mixture of LP equity and pref equity. Not obviously people have different investment preferences, but again, like a lot of sponsors that might not want pref with some uncertainty in the market, and might not want pref eating away at their LP if push goes to shove. And it's a good deal, and everyone thinks it's a good deal. There will not be opportunity for pref.
Zach, so it depends though, right? Like if you can get the upside that you think you're going to get, it's sort of like a one tier waterfall, right? It's just that I think what has happened in the past where people were just too aggressive, and in this market, people still haven't adjusted their expectations, which is why I think you have to try to be very careful, right? Because a lot of people, that jumped into multifamily, they have no experience, right? The article you sent me, Wayne, a lot of people jumped in 2020, 2021, and they're not going to get the liquidity that they expected that's going to make them strong enough to weather this storm. So I think it's going to be a very interesting period. And I think looking back, as I think about the financial crisis, a lot of real estate overall fundamentally is if you're getting it in a good area, in a growing area. What I can say though, that you might have a really good piece of real estate, it's just really bad capital structure, right? And if you can somehow get through a bad period where you can fix the capital structure and the value goes up, you should technically be okay if you are an experienced manager. I think like the problems comes in is when people don't have the experience, they don't have the money, they don't have the ability, the liquidity, and they don't have the ability to fix maybe a missed interest payment because vacancy went down, right? And now we didn't have to worry about that because rates were so low, right, for a while that you didn't have to really do much. Now you're going to have to really see who's experienced and knows what they're doing. And you two guys have that experience, hopefully, and our portfolio with you guys will do well. So before we go, Wayne, can you talk about any last words, your predictions for 2023?
The way I think it's going to be, we're coming out of the holiday periods, and I think there's going to be a lot more deals hitting the market. It was very slow in the last part of 2022. I think you're going to see more deals hitting the market. I think you're going to see some blood in the water for the first, I think it's going to be a little bit choppy for the first, probably 3/4 of the year, but maybe the first half. But regardless of whether or not we end into a recession or we keep at the constant interest rate, I think just the clarity of the trajectory of the interest rate environment and the cap rate environment will provide a little bit more stabilization to the market. So I think that by the end, the last quarter of 2023, I expect to see a lot more stability, a lot more competition for the deals, a lot more people with their pencils back up because they realize, look, this is the new normal. We're either going to not operate at all, or we're going to learn to operate in a new normal. These interest rates that we're in are still ridiculously historically low. And, people need to either they're gonna, if 6% interest rates are scaring you off, you wouldn't have been able to operate for the last 35 years. I mean, before we hit 2008 and things like that, that's what they were. I mean, so if we go back to there, that's just going back to normal. And I think that people will adjust. And so I kind of think that we're going to get back to a more normal market at the end of 2023. And I think it'll be a good opportunity to keep dollar cost average buying. You keep looking for good deals that pencil. And like you say, with the private equity, especially if you could get assumptions, you could make it to where your blended effective interest rate, even with a pref equity, is positive leverage in terms of the purchase to tax adjusted cap rate, and also below the inflation rate. You may be able to be fine, depending on how much you take on of the pref equity. And that's the kind of deals that we're going to be looking for.
Great. Thank you. Thank you very much, Wayne. Zach, you want to have anything for 2023?
I agree with pretty much everything Wayne said. I think 2023 is going to be a year of opportunity. There really hasn't been a whole lot of deals over the past 4 to 5 months. And I think going into Q1, Q2, the floodgates will start to open. People will start selling, maybe not selling at distress, but people that had the ability to acquire at a good basis over the past 2, 3, 4 years with their debt coming due, they can exit at a small gain. So I think it's important to just be diligent and have pencils ready for when opportunities come up. As it relates to debt, I think this is, and we think this is the new normal. And by new, if you get rid of the past 2 years, this has been normal, kind of where debt is currently. So it's just readjusting underwriting to kind of reflect the higher exits and the higher debt costs. I think the market is pricing in that there may be one more rate hike, and then the Fed is going to start cutting rates. I personally believe that the Fed originally planned 2 rate hikes, and they'll do what they said. The Fed is looking at the long-term inflation effects, not what's happening this year, but what's happening in 2, 3, 4, 5 years. It's obviously impossible to predict what the Fed will do and how the market is going to react, but it's our job as stewards of capital and investors, sponsors, and partners to prepare ourselves with knowledge and research and make the best educated assumptions and decisions we can as it relates to our existing portfolio and future opportunities. So while we do believe that the kind of where debt is today is here to stay, we feel like with that there'll be a ton of opportunity, and we're just positioning ourselves to be in the best position for when those opportunities come around.
Great. Thank you, guys. Happy New Year. And it's been great working with you guys.
Thanks, Sasha. Thanks, Ryan.
Thanks a lot, Sasha.